Alright, hello everyone, this is Nick Lump. This is being recorded on Thursday morning, May 8th, and I've had a similar conversation with a couple people the past few days talking about kind of what's going on in the stock market, so I figured it would be a good idea to record this and send it out to everyone. And what we're seeing right now, what's going on in the past few weeks, is what's called a rotation, and this happens just about every year. But what it means really is that there's a change in the type of stocks that investors want to own and the stocks that they're buying. And you see this because a lot of the funds that kind of drive the markets these days it's really primarily what are called momentum funds, things like hedge funds and so on that. Their goal, they're more short-term traders than investors. So whenever there's an industry or a style of stocks that are doing well and it's in a steady uptrend, they all jump on board and lever up, and they buy a lot of these same kind of stocks. So they all are buying the same ones and they drive them higher. And then as soon as that trend seems to be slowing or ending and that style changes, they all try to sell them at the same time. And so as you see this rotation in and out of certain styles, you'll see certain sectors, for example, outperform and then greatly underperform. And that's what we're seeing right now. And we can see this by looking at, I have 4 different indices up here, these indexes. This top left here is the S&P 500, which are 500 largest U.S. stocks. So these are mainly large cap companies, really big companies. Top right is the Dow Jones Industrial Average, which are 30, it's only 30 stocks in the Dow, but it's 30 of your really large kind of blue chip stable companies like ExxonMobil and so on. Down here in the bottom left is the NASDAQ, and the NASDAQ is primarily a lot of technology names, biotech companies, companies that are more associated with higher growth. And the bottom right is the Russell 2000, which are small companies, small cap stocks. And so this rotation that we're seeing, everything that worked really well last year in 2013 were things like technology names, biotech names, really things that had high growth rates or high growth in terms of sales year over year. But now that they've gone out of style, what you're seeing is the NASDAQ, all of these high growth companies, and anything that's a smaller company like the small caps, greatly underperforming. As you can see, both of these have been falling quite a bit, and they're even trading like they want to continue to move lower. And all of the money is coming out of these and is moving into your really large cap blue chip dividend paying stocks. Like I said, your Johnson and Johnsons and your Chevron and ExxonMobil and these really large stable companies. And so you're seeing that while the small caps, the higher growth stocks have been moving lower, the Dow and the S&P, which are a lot of your larger names, they've been holding real steady, kind of bumping up along these highs here where I drew this red line. So these are starting to outperform as you see money, sell out of the high growth and move into these blue chip companies. And so we have quite a divergence here. The interesting thing is when right now we're in earnings season, and this can often be pretty confusing. This is one of the things that makes the stock market, very confusing to investors, is that it doesn't matter what a company says when they report earnings. It could be the best quarter imaginable in terms of sales growth and profits and so on. But if that company is out of favor right now, meaning let's say it's a smaller company, it's a high growth company, it doesn't matter what they say. Because that stock is just not loved right now, the stock will trade lower. And really, that's something that as a long-term investor, that's what you view as an opportunity when what the stock price is doing is not reflective of what the underlying business and company is doing. That's a great opportunity to buy more. So we've been seeing that quite a bit. And internally, for example, I was talking to a friend about Under Armour, and in my opinion, they've reported a fantastic quarter, but the stock has been moving lower, and really it's been selling off the past few weeks. So this was an opportunity that I've been able to buy more of that. So I'm seeing this in a lot of names, pretty similar. So while I'm maintaining allocation to stocks within the portfolio is just about the same right now. Internally, I am rebalancing where stocks that have done well, I'll kind of take profits and sell some of those. And this has been an opportunity to then cycle that money into ones that have gotten knocked down that I view as still doing really well and is a smart investment to make. So that's kind of what's going on right here. I think really we're going to see more of this throughout the whole summer. Really, I think this rotation has more to run. So when you have it's almost like we're in limbo where some stocks are selling off, others are kind of holding steady. But until you have that view that all stocks are good to buy again, we're just going to be kind of chopping sideways. And seasonally, May and June tend to be pretty bumpy months, or they can be. So I think that's also in the back of a lot of people's minds. And really, like I said, we're kind of in limbo where the bulls aren't really, they don't see enough, and they're not kind of, we'll say, brave enough to really push the market higher to the next level. But at the same time, things aren't, we're slowly seeing a recovery economic-wise here in the U.S., but things aren't bad enough to knock the whole market down. So it's just kind of this back and forth, real short term. So that's kind of more of what I expect all summer. The one thing that is concerning me right now is that the yield curve, which measures the interest rates at various maturities on Treasury bonds, has been flattening quite a bit during this rotation, and that's kind of a sign that the economy is not doing as well as people hoped. So that's certainly something I'm kind of keeping an eye on. We'll see how that plays out, but I think a lot of that is being driven by Europe right now, as Europe is continuing their quantitative easing programs, and they're suppressing and holding their interest rates lower. And we've gotten to a point now where, for example, the Italian and then the Spanish 10-year government bond is yielding, about the same or even lower as the U.S. 10-year Treasury bond. And so no one's going to buy, for example, an Italian or a Spanish government bond if they can earn the same interest in a U.S. government. So that's kind of keeping what's called a bid underneath these bonds, and it's holding the prices up, which is holding interest rates lower. So we'll see how the economy picks up. We had a real rough winter heading in, but we'll see how things, if they're able to pick up in the spring, and how that can translate hopefully into higher stock prices later this year.